Time now for the word on Wall Street. Top investors watching your money. Joining me now, Barron's market reporter Jacob Sonenshine. Also with me on set, Greg Farinello. Jacob, good morning. We're going to start with you on this one, taking a look at futures. A little bit of a, well, actually, the Dow just ticked up higher, 11 points. So I guess that was you joining us on set. Thank you. I don't know. Anyway, the S&P and the NASDAQ are slightly lower, but hey, it's been a great year. You did have all three major indices end the day lower yesterday. We had a little bit of a tech sell-off. But going into the year end, you kind of see that people are making portfolio moves before they close out their book for the year. Tech and AI did dominate the market for the year. The NASDAQ rallied nearly 22% this year. That outperformed both the Dow and the S&P 500. Global semiconductor sales topping $400 billion in 2025. Unbelievable. Chip makers bracing for an even bigger 2026. Demand for computing power is surging, and NVIDIA is now facing competition from Google and Amazon, even after they signed that $20 billion deal with Grok. Analysts are warning that long-term AI financing, power, and supply constraints are emerging as risks for the year. A lot to throw at you, Jacob. Your reaction?
Yeah, I was reading an interesting chart from Evercore, the strategist there last night, and he was saying that the percent of equities that corporations own versus households or money managers, the percent that corporations own is historically not that alarming right now. So that's the circular financing risk that you're talking about. That risk is still there. I think the big risk going into 2026 or just the next couple of years really is that nobody really knows when Meta, Microsoft, Oracle, or Amazon is going to say, we're going to slow down the rate of growth of our capital investments. They may do it. And nobody knows when that moment is coming. And it doesn't mean...
But in what regard, though?
Because...
What is the slowdown? What is the cause of that?
Oh, yeah, because they have built out so much in the way of data centers to make sure that they don't underinvest. Google said a couple years ago, we're probably going to overinvest. They didn't say those words. They say we'd rather overinvest than underinvest. That risk is there. And if that data center build out slows down, then your revenue and earnings for chip makers and all that stuff, gets hit.
Well, Maria's brought that up. It's ROI. There's a risk. And this conversation's been happening for months now. Just in general, the chatter is that these companies are spending. I mean, we're talking $1 trillion spend here on these data centers. But when does that money come back to you and to shareholders? So it's a fair assessment that you're making.
And it could come back in terms of the software companies because they're going to recognize a lot of revenue this year or next year. If they don't, those software companies are going to say, we can't keep adding data centers.
Yeah. Greg, let's talk about private equity, another trend here that we've been watching for the year. A lot of these PE firms are entering 2026, and they're still going through a huge backlog of unsold companies. And we saw a pickup in deal-making, IPOs. We think we're going to get more next year. Higher interest rates over the past few years have kind of been stretching these whole periods. But a lot of firms are sitting on nearly 13,000 portfolio companies. That's a lot of deals that need to happen. You think that picks up in 2026?
I do. I think the deal activity that we've seen this year, you're going to see it magnified next year. In terms of private equity in general, we've seen an explosion in private equity really since the global financial crisis in 2008. I think a lot of these companies are really good. I think the private equity firms are very well managed in terms of what they're doing. But in terms of deal activity heading into 2026, I think we're going to see an explosion. And the regulatory environment is going to be very friendly.
There is definitely a deregulation push even further going into 2026. I think the Trump administration is just getting started
100%
with that.
Yeah.
Let's take a look at yields this morning. We're talking about these two major decisions coming up for next year. You've got the Supreme Court decision on President Trump's tariff authority, and of course, who's going to be the next chairman of the Fed. Now, President Trump again raising pressure on the Federal Reserve, saying he'd love to fire Chair Jerome Powell, also signaling he's got a preferred candidate to lead the bank. The decision likely in January. Treasury Secretary Besson had first told Maria that. The president again calling on Powell to resign, pushing for a more aggressive approach on rates. And, Jacob, the Wall Street Journal wrote this, how investors are preparing for a new Fed. And they say markets have shown few signs of significant concern that the Fed would completely surrender its independence. Still, though, they're bracing for a Fed next year that's going to have unusual division, they say.
It's funny because if you bring in a new Fed chair that is dovish, that wants rates to be a little bit lower, that dynamic in the near term forces the price of stocks lower. It forces them higher. Sorry, right? Stocks have to go. No. Right? No, stocks have to go higher. But the long-term risk is that if you have a central bank that is only focused on lowering rates wherever you possibly can, you create the risk of bubbles. You create the risk of inflation. But in the short term, the market is forced upward. Let me be clear. I meant to say that.
Yeah. No, and the journal pointed that out too. The risk of inflation, absolutely, and that's something that and again, it is a board. It's not just one individual. It is a board,
yes.
And so that dynamic is going to be interesting. Greg, your reaction to that?
Yeah, look, I think you said it best. It is a committee at the end of the day. I believe in central bank independence. I've said this on the show. I've written it publicly to clients. There are a lot of good candidates out there. My preferred candidate is Fed Governor Chris Waller, because I believe he understands the institution. He's been around there for a long time. There are a lot of great candidates out there, but this market really wants to see someone, in my view, that is somewhat independent. So if the president makes a decision, and he might, and he may be watching the show, if he makes a decision to put someone very close to him into that institution, I don't think that's going to be good for markets.
Yeah, well, again, the journal has a good...
And he may do that, but I don't think it's going to be good for markets in general.
No, I mean, the market will enjoy something that it knows is not good in the long term. That can happen.
On many levels over the years. Jacob Sonenshine, it's great to see you. Happy New Year.
Happy New Year.
Yeah, thanks for being here.